If I could sit down with the 25-year-old version of myself today, there's some things I'd tell him before he bought another stock. And none of these came from a textbook. Every one of them came from making mistakes, missing opportunities, and investing for more than 30 years. What really got me thinking about this was a client who turned less than $10,000 into about $500,000. Bitcoin, Dogecoin, right place, right time. I asked him, so what's your exit plan? The way he looked at me, you could tell he had never thought about it. And that conversation stuck with me. And we'll circle back to him in a minute. But the first thing I tell the 25-year-old me starts with a stock I didn't even buy. I remember Amazon in the late 90s and early 2000s, and I didn't buy it. Today, people look back and act like, well, that was an obvious buy. But it wasn't that simple then. E-commerce was new, cash was still king. A lot of people, they just didn't trust buying things online. Amazon was mostly an online bookstore, and the company was losing a lot of money. The stock was expensive, and there were plenty of other internet companies with big growth stories. I also remember looking at eBay and thinking, man, that was the dumbest idea. Who's going to buy yard sale stuff online from strangers? Shows you how much I know. But looking back, both companies became incredible businesses, but it wasn't obvious back then. Some internet companies disappeared. Others changed the world. There was just no way to know which would be which. You're going to miss some great stocks. Lord knows I have, man. I could make a list. But you don't have to own every great company. You just have to stay in the game long enough to find some of them. But staying in the game requires something that was hard to appreciate at 25, at least for me. Time. At 25, I understood the math. I had read the books and listened to the experts. That's why I invested. I could look at the illustration and understand what it was showing me. What I couldn't understand at 25 was what 30 years down the road actually felt like. 30 years was longer than I'd been alive. There was no way for me to relate to that amount of time. I couldn't comprehend turning 40, and you're telling me to look at what it could be at 60. I had to trust the process before I had any personal evidence that it even worked. Now at 57, I've lived long enough to see what decades of compounding can do. I wish I could somehow show that to the younger me instead of just telling him to trust it. Compounding truly works if the money keeps showing up month after month. If you've watched this channel before, you've probably heard me say you're building a financial house, and the strongest part of any house is the foundation. Consistent investing is part of that foundation. But there were months when we had kids, rental repairs, and just life itself. And I tell myself, I'll invest at the end of the month. And sometimes I did, and sometimes I didn't. Looking back, it wasn't the $25 I missed. It was the time that money never got to compound. That's why I'd absolutely automate something. It doesn't have to be a large amount. It just needs to keep working when life gets busy. Automating the contribution is one decision. Where that money goes is another. Roth IRAs weren't available when I was 25, but once it became available, I understood how it worked, and I contributed. I just didn't utilize it the way I wish I had. At the time, a lot of our extra money was going into the apartment properties. Money outside the Roth felt more flexible because I could use it for another property or repairs or other opportunities. Money inside the Roth felt tied up. I don't regret buying the apartments. They worked out okay. But looking back, I wish I had carved out a little more for the Roth each year, even if it was a small amount. I found money for some of the drip stocks I was buying. I probably could have found a little more for the Roth too. Now that we're getting closer to the point where we may start taking some of the money out, the value is much easier to see. You know, when we take qualified withdrawals, we're not going to owe federal income tax on that money. And not owing the tax man, it's going to be pretty nice. And I understood that rule years ago. I just didn't use the account as fully as I wish I had. There's something else I would tell the 25-year-old me. I spent a lot of time trying to figure out which individual stocks to buy. Today, I'd remind myself there was another option. I could have simply put more of that money into a low-cost index fund. I wouldn't have owned every winner, but I would have owned a small piece of many of them and lowered our risk. Over time, that would have been enough. There's nothing wrong with owning individual stocks. I still own individual stocks today. But when I did decide to buy one, I learned another lesson the hard way. Years ago, I bought QQQ. I still have the trade confirmation showing where I bought 500 shares of the Q, and I bought the whole position at once. Because I had committed the full amount, I watched it constantly. Every time it dipped, I started thinking about protecting my capital, and eventually I sold. Looking back, the Q wasn't the problem. My positioning in it was. Had I started with a smaller capital position and added over time, I think I would have been more comfortable holding through normal volatility. Building a position gradually doesn't just change how you buy, it can change how you behave after you buy it. Position size wasn't the only thing that made me a nervous holder. Not knowing exactly why I own something did too. It's fine if somebody gives you a stock idea, but before you buy it, do your own research and make sure you understand why you own it to begin with. Maybe your friend heard it from his plumber, who heard it from a mechanic, who heard it from a customer. By the time the idea gets to you, nobody remembers where it started or why the stock was supposed to be a good investment. A few years ago, some investors even confused Zoom Video with another publicly traded company that had Zoom in its name. They didn't just misunderstand the investment, they bought the wrong company. If you don't know why you bought something, you won't know whether a price drop means you should add, continue holding, or get out. Knowing why you bought something also means being honest about which part of the story is real and which part is just hype. I remember how heavily 5G was promoted as the next major investing theme. The technology was real, well, for the most part. I mean, they just had a little physics problem with it. But that didn't mean every company connected to 5G was going to be a great long-term investment. We've seen the same thing with other themes. A new technology can change the world without every stock attached to it becoming a winner. The story may be exciting, but you still have to look at the company behind it. Another thing that helped me was having someone around me who invested. One of my best friends from growing up, he and I started investing around the same time. And we would talk about companies. We shared ideas, kept each other interested in investing. More importantly, though, we shared many long-term goals. He stayed focused mainly on stocks. No, he's not the one who suggested Global Crossing, MCI, WorldCom, or CMGI. That was some other friend. I continued investing, but I also started buying real estate. And he stayed with the stocks, and we both did okay. But talking about investing kept investing in front of both of us. Of course, recognizing an opportunity doesn't help if you don't have money available to act. And there were times when I was completely invested in the market, and then a company I had been watching became attractive, or the market dropped, and I didn't have any cash available. My choices were to watch the opportunity pass or to sell something else so that I could get it. I'm not saying you should always sit there with a large amount of cash, and I'm not talking about trying to time the market. I just wish I had left myself enough flexibility to act when an opportunity came along. Flexibility is about being ready to buy. The last lesson is about being ready for the opposite, knowing what you'll do if you're right. Back to the client that I mentioned at the beginning. He had less than $10,000 in Bitcoin and Dogecoin, and at one point it was worth around $500,000. And I asked him, so what's your exit plan? The way he looked at me, I could tell you, he had never thought about it. I said, dude, you are sitting on an enormous profit in something that's very volatile. Have you ever thought about just taking a wee bit off the table? He had an entry point, but he had never thought about if the investment worked. And that conversation stuck with me. Most investors spend a lot of time thinking about what they're going to buy. They spend much less time thinking about what happens if they're right. An exit plan doesn't mean predicting the top. It may mean recovering your original investment. selling part of your position, or reducing risk as you get closer to retirement. Years ago, if I owned 50 shares of something and it went up substantially, I might just sell all 50 shares. And then I'd have no shares left, and sometimes the stock continued going higher. And then I'm looking at it going, well, nothing. Looking back, I could have sold 10, 20 shares, recovered some or all of my original capital, and allowed the remaining shares to keep working. Selling doesn't have to be an all or nothing decision. Most investors have a plan to buy. Make sure you also have a plan for what happens if you're right.